Welcome back. In this video, we're going to dive into the details of a few successful syndication deals that we completed at Nighthawk Equity. Now, these case studies are going to give you a clear understanding of what we actually do to achieve the returns that we do for our investors. So if you're a bit of a numbers person, this one's for you, but also it's a lot about the story as well. Let's start with Dogwood Trace in Memphis, Tennessee. This was a 168-unit property we purchased in June of 2018. We invested just under $1.2 million in capital with a projected hold period of 5 years. Now, our strategy here was pretty straightforward. Acquire the property. It needed value add, some renovations, leverage our in-house construction team for quick and cost-effective renovations, and rebrand and improve operations and management to drive up rents and overall valuation. Now, the original projection was an equity multiple of 1.9 over 5 years, and that was an IRR of 14.2. Now, by optimizing our renovation process and improving the property's operations, we were able to achieve an actual equity multiple of 4x, which was quite a bit higher than our projection, and not in 5 years, but in 4 years. And that was extraordinary IRR of 45%, which far exceeds our original expectations. Now, really, while economic growth was on our back and really helped this deal along the general market, it is definitely compounded by strategic renovations and improving management. And this is what I love about this asset class, is because you can what's called force appreciation. I don't need the market to improve like with a house, right? A house, whether it has rental income or not, is really valued like the other houses alike it in the area. And with commercial real estate in general, that is not the case. Meaning that if I improve the property, increase NOI, the value of the property will go up. And the reason we got the higher than projected returns on this was because the market cooperating and really compounded the returns, and that can sometimes happen. And this was really kind of a unique, phenomenal deal. The returns were much higher than projected. And let's talk through a more standard deal next, but it will still demonstrate the entire idea around forcing appreciation. So there's Tree Haven Glen. It's a 71 unit in Huntsville, Alabama, and we acquired that in August of 2018. This was more of a same thing, classic value add play. We invested $650,000 in capital. Our goal again was to hold the property for 5 years. It had a projected equity multiple of 1.5x and a 14.2% IRR. Now, we managed to complete the renovations and stabilize the property much faster than anticipated, which is cool, and that has allowed us to exit in just 2.5 years. The actual equity multiple came in slightly below our projection of 1.5x, but we still hit our IRR of 15%. Now, why are we exiting this earlier than expected? And this is a little bit of a kind of making a call on the playing field as it goes on, but typically we really want to achieve the returns for our investors. And so if we're targeting IRR, a lot of it goes into the timing of that, because the IRR does take in the passing of time. So in a value add deal, you are building a lot of value in the first couple of years, that you build the most value, and then you want to coast a little bit, but then the IRR starts to plateau off as not a lot of value is being added in years 4 and 5. So in this particular case, after 2.5 years, we said the IRRs are 15%. We hit our target. Let's exit this investment. Now, finally, let's talk about another deal, Monarch Villas in Georgia, this outside of Atlanta, 130-unit property that exemplifies our ability to execute a full cycle from acquisition to value add to exit. And we bought this property with a target IRR 15%, and the equity multiple was 1.9. It was, again, a 5-year hold. And following our playbook of strategic renovations, we actually rebranded the property, and we executed a very comprehensive exterior renovation plan, and we crushed it within 8 months. We significantly increased rents, and we achieved rent amounts in that time that we originally expected to hit by the 5th year. And we did all this in the 2nd year. And again, as a result, we sold the property earlier than initially projected, and we also exceeded our return to projections. So instead of 15% IRR, we were able to hit an 18% and an equity multiple of 1.4x. Now, with the equity multiple, if we held a little bit longer, it would have been higher. In fact, for a 5-year hold, it would have been a 2.4x. But again, it would have required another 2 years of hold, and that would have started to decrease the IRR. So again, it's a little bit of what's more important, and we're paying attention to the return on equity and also the speed of appreciation, and we want to maximize that return for our investors. All right, so there you have it, 3 different properties, each reflecting our disciplined approach to investing in value-add multifamily real estate. And really, these aren't just numbers. They represent real gains for our investors. And they're achieved through a strategic mix of acquisition, efficient renovations, and then well-timed exits. Like, we have a playbook, we follow it. We do make some calls in the field as the market shifts, but overall, it's a very, very repeatable process for us. So if you're considering investing with us, these case studies should give you some confidence in our ability to deliver strong, consistent returns, and that's what we really want to do. We don't really want to crush returns. We want to deliver predictable results to you. Now, if you'd like to learn more or discuss how you can be part of our next successful successful deal, then don't hesitate to reach out. We'd love to have a conversation with you. Just click the button below in this video. There's a link here. You can book a no obligation call with us and find out more about us, and we'll find out more about you and then share some upcoming opportunities. So with that, let's move on. See you in the next video.